Now, in this case, we are going to assume that this importing country is a large country. What that means is that it can influence the world prices. Yeah? So when it imposes a tariff, there is a decrease in, when it imposes a tariff, there is a decrease in the demand for this good in the world market. Demand for imports decrease, and imports, I'm just going to use the term M, okay? Demand for imports decrease. So what happens in the world market is that the price for this good is going to fall, okay? So that is the relation here. So now this large country imposes a tariff. Let's say it imposes a tariff of $T, which is equal to, just like the case before, $3, yeah? And the world price to begin with was, let's assume it was $5, yeah? Now the world price falls as a result of the tariff. So the new world price, I'm going to assume that the new world price in this case is, let's say, $4, yeah? And let's donate this with a star to differentiate between the original world price and the new world price. Now what happens? Well, world price has fallen, and now when the domestic producers are looking at purchasing from home or the foreign country, they have to pay a $3 tariff. Yeah? So what happens to the domestic price? Well, it is going to rise by the amount of the tariff, because whenever consumers in this country purchase this good from the foreign country, they have to pay a tariff of $3. So the domestic market is going to rise by the amount of $3, but this time it is going to rise from the new world price, because that's the world price now. Yeah. And so if this was your level of tariff, there is an increase. The world prices have, the domestic price has increased, and how much? Well, by the new world price plus tariff. Yeah. If you had to give a dollar amount, the tariff amount of the tariff was $3. Yeah. So it has increased by the amount by it is now $7. Okay. Now let me just show you guys what the new level of, what can you tell us about the level of imports now? Well, it is world price, the new world price plus tariff. This is the amount that is now being imported by this large country. Okay. And comparing this to the previous one, well, in the before the tariff, this was the world price, and this is how much they were importing. Yeah, that makes sense, right? So there is a decrease in the level of imports in this case. And so now what we want to do is we want to look at what happens to the welfare, change in consumer surplus and producer surplus. So let's look at the welfare analysis in this case. Okay, and we are going to do this by looking at the change in consumer surplus, change in producer surplus, and since there is a tariff, there is going to be a tariff revenue that is going to be earned by the government. Yeah. Okay. So to look at change in consumer surplus, we are going to look at what was the price before the tariff was imposed. Yeah. And after. So before, it was PW. This is the world price, and this is what the price was at home, because this country was trading freely in the world market. Yeah. After the tariff was imposed, what is the price in this country, the domestic price? Well, it is PW star, the new world price, plus the tariff that they have imposed. These are the two prices that we have to look at. Yeah. Now again, doing the same thing as before, change in consumer surplus. Prior to the tariff, it was the area below the demand function and above the price. This was a consumer surplus. Yeah. After the tariff was imposed, it is the new price that consumers are paying, below the demand function, this area. Yeah. So what is the change in consumer surplus? Well, it's the difference between the two prices here and the area below the demand function. Yeah. That is what the domestic consumers are facing. All right. So let's now label these A, B, C, D, and I'm going to call this, let's call this F. Okay. And you'll see why we need that area as well. So what is the change in consumer surplus? Well, it's negative because the prices have increased, so consumers are going to be worse off. It's the area A plus B plus C plus D. That's right. What about the change in producer surplus? Well, it is going to be A, and if you look here, it is the two price changes. Yeah. And the area above the supply function. So this is the change in producer surplus, right? So tariff revenue in this case is, producer surplus in this case is A. What about tariff revenue? It is tariff into the new level of imports, how much you are importing now. Okay, and that area is, if you could look here, this is the new level of imports. Yeah, this is the new level of imports. Yeah, you can measure it at any place. This is the new level of imports. What about tariff? Well, this is where we make mistakes sometimes. If you're in a rush, we tend to think that this is the tariff. So this is the tariff revenue because this is what it was in case of small country. But the tariff is being measured from the new world price, not the old world price, the new world price. Yeah. So the amount of tariff is this. This is the amount of tariff. It's PW star plus T. Yeah. This is the amount of tariff. And how much are you importing? This country importing? Well, it's this much. So this multiplied by this gives us the area of this rectangle here. Yeah. Cool, huh? So what is the tariff revenue in this case? Well, it is plus, because the government is earning this, C plus F. It is this F that brings about a difference between the welfare change for small and the large country. Okay, so this is your change in welfare. So what is the net welfare change in this case? Well, the net welfare change is you're going to add and subtract these. Yeah, and again we're going to do the same thing that we did before. We are going to say, well, from consumer surplus lost A, B, C, D, that much area. Yeah, surplus measured by that area. A was transferred to the producers, so that cancels out, minus A plus A. C was captured by the government as tariff revenue. C cancels out. What are we left with? Well, we are left with a negative B plus D and a positive F, which is coming from tariff revenue, right? Now, B plus D, if you look at this here, B plus D is how much the country was producing before and how much it's producing afterwards. Yeah, so that is a distortion loss. Okay, now if you remember from before the tariff was imposed, this is how much the country was producing. Yeah, and after tariffs were imposed, there was an increase in production at home by this much amount. They are now producing a good that they don't have a comparative advantage in. Yeah, this importing country's cost of producing this good is much higher than the foreign country, which is the world price PW. So you just distorted the choices for the producers such that they moved their resources from maybe another production where they had a comparative advantage to production of this good that they don't have comparative advantage in. So B is your production distortion loss. Yeah. What about consumption distortion loss? That is an increase in the a decrease in the consumption of the good because you now have a tariff imposed. So this is your consumption distortion loss. Sorry. Okay, and both of them together are referred to as dead weight loss because this doesn't accrue to anyone, this doesn't go to anyone, it just poofs, disappear. Okay, now what about F? Where is this F coming from? Well, let's have a look. Why does this large country have this extra gain, F? Where did this come from? Look at the graph. Well, F is the level of imports, the new level of imports, and on the y-axis, the price, what is it? It's the difference in the world prices. It's the dip in the world price as a result of the tariff. Difference between the original world price and the new world price. Yeah. Now that is your terms of trade gain. Do you guys remember what is terms of trade? Well, terms of trade, this is price of an exported good over price of an imported good. Yeah. Think about price of export. X is you're selling the good, what your earnings are. Yeah, earnings are. Imported good, this is where you're spending money. This is your spending, your earnings. Yeah. So if your earnings increase, you're going to be better off. So terms of trade are improving. If the price of the good that you're purchasing, what you're spending money on, increases, you're going to be worse off because you're spending more. Yeah. So this is your terms of trade. In this case, for this importing country, the price of imports just fell. Yeah. So what happened to this ratio? Well, it increased because your denominator fell. Yeah. So there are terms of trade gain. That's what this F is the amount by which the world prices fell into the level of imports. What that means is that before the tariff, you were paying $5 for each unit that you were importing. Yeah. After the tariff, the world prices fell. Now you're only paying $4 for each unit that you're importing. Yeah. So your expenditure just fell. Yeah. That's what this is representing. This level of imports prior to the tariff, you're paying $5. Now you're only paying $4. So your expenditure on imports has fallen. Yeah. For this level of imports, you were initially paying $5. Now you're only paying $4. So this is the extra gain you've made. Why? Because now you're spending less money on imported good. And this is referred to as your, F is referred to as your terms of trade gains. All right. All right, guys. Yeah. Now, let me highlight this point. This is your total change in welfare. It consists of production distortion law, it consists of deadweight loss and terms of trade gain. Yeah. So what can we say as far as this country is concerned? Are they better off with the tariff or not? Well, it depends. Is tariff beneficial for, this is the kind of question that you might be asked, is tariff welfare improving for a large country? For a large country, well, we don't know, because whether the change in welfare minus B plus D plus F is positive or negative compared to 0 depends upon whether B plus D is bigger or smaller than F. Yeah, whenever the positive terms of trade gains are larger than the deadweight loss of a tariff, the country is better off. So what can we say about gains from imposing a tariff for a large country? Well, it would depend upon, and if we were to draw a graph, generally there is a graph for an optimum tariff for a large country. If you were to measure at different levels of tariff, what is on the y-axis, you measured minus B plus D, which is terms of trade loss, plus E, which was, sorry, minus B plus T, which was deadweight loss, plus E, which was terms of trade gain. And you asked yourself, and you did this analysis, for a small level of tariff, generally speaking, E is bigger than B plus T. As you keep raising your tariffs, it keeps raising up to a point beyond which it starts becoming welfare reducing. And this point at which you maximize the welfare is generally referred to as the optimum tariff. Yeah? So another question that's generally asked is, for a large country, what is the optimum tariff? And the answer is, the optimum tariff for a large country is positive. That means there is a certain level of tariff for which imposing the tariff is going to be welfare improving for a large country. All right, guys, so this is your analysis for the large country. The difference from the small country is primarily that the world prices have